Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. In this video we will be doing an analysis of Monster Beverage Corp and seeing if it would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Now, let's go ahead and jump right in. Cue the logo. Let's start with some background info on Monster Beverage Corporation. Monster was founded in 1935 in Southern California as Hansen's and originally sold juice products. Fast forward to 2012 when the name was changed to Monster and the company began to focus on energy drinks in 2015. That same year Coca-Cola bought a 17% stake for $2.15 billion and has remained a large shareholder. Today both the value and size of that position have grown tremendously. Now let's look at the price action. Starting with the 1-year chart we see that Monster had a CAGR of about 20%. Zooming out to the 5-year chart we see that Monster had a CAGR of about 12%. These are some excellent returns. Now, let's take a look at the fundamentals. Gross margin is good at 52%. Revenue has compounded at around 13% over the past 5 years and has topped $6.7 billion most recently. Good revenue growth and great gross margin makes me thirsty for more. Let's explore. Looking at the cash flows we see that operating cash flow has risen at a 6% CAGR over the last 5 years, while capex has increased at a CAGR of 25%. Free cash flow rose at a 5% CAGR during this time period, while free cash flow readily outweighs capex nearly 8-to-1. Capex is expanding at a much more rapid pace. Next, weighted average shares outstanding have been decreasing over time, going from 1.13 billion shares in 2018 to 1.06 billion most recently. Monster has been decreasing share count at around a 1% CAGR. Now let's view my favorite metric, return on invested capital. Return on invested capital has fallen from 33% in 2018 to 30% most recently, though it peaked in 2020. The recent fall in return on invested capital is not ideal. Another favorite metric is cash conversion cycle, a measure of operational efficiency at the company, going from 50 days in 2018 to 106 days most recently. Monster is demonstrating declining leverage. Seeing this means that their efficiency and management of inventory is declining. Last, let's explore Monster's debt. The net debt to EBITDA has been improving over time, falling from -0.7 in 2018 to -1.7 most recently. In this case with EBITDA being positive, the negative net debt to EBITDA value for Monster means that the company has more cash on hand than debt. This is a very good sign and has been improving over time. The fundamentals of Monster are good. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Monster. It is a beverage company with a gross margin of 52%. The 5-year revenue per share CAGR is 14% and the 5-year free cash flow per share CAGR is 6%. While the revenue growth is outstanding, free cash flow growth could be a lot higher. A return on invested capital of 30% is good, but it is on a downtrend. Next, the cash conversion cycle of 106 days is much longer than I was expecting to see. This means it takes Monster over 3 months to get paid from selling products after they pay their suppliers for the materials to make the product. Concerning debt, a net debt to EBITDA of -1.7 means the company has cash in excess of any debt and is profitable. So from a fundamental standpoint, Monster is pretty good. Now let's switch our attention over to valuation. Monster is overvalued relative to the S&P 500 with a ratio of 1.6. Given its history of tremendous growth, Monster appears to be trading at a premium. The price to earnings growth, or PEG ratio, is 1.8, which means that Monster is trading at a premium to its expected earnings growth. Monster has had an amazing run as a public company, returning a nearly 30% CAGR since debuting in the public markets. The strong revenue growth and fat margins along with high return on invested capital imply that there is runway for further growth. My guess is that future growth will come from expansion into new markets, with Southeast Asia and Africa being the next growth targets. Monster has long had strong management and employs a unique co-CEO strategy. I certainly love the growth, but the valuation is currently a bit too high. If we get a decent pullback in share price, this may be a strong candidate to buy. For now I will keep it on the watch list. Many thanks for watching. What do you think about Monster and its growth? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.